Hello and welcome to another episode of Angel Insights, the show that goes deep into the world of angel investing. I'm Tom Britton, co-founder of SyndicateRoom, and if you want more on our flagship Access EIS fund, head on over to www.syndicateroom.com or follow me at Tom Britton or SyndicateRoom at SyndicateRoom on Twitter. On today's episode, I'm delighted to welcome Brian Moretta to the show. Brian, it's a pleasure to have you on the show today. Thanks for joining us.
Absolutely. It's my pleasure to join you too.
I was actually on your podcast a little while back, and now the tables have turned. So I'm going to be doing the grilling today. See how you like it for a change.
Yes, it's an unusual position for me. So I'm looking forward to it with that little degree of nervousness, as my laugh probably reveals.
Today's actually kind of a special day for us. So we usually have angels on the show, and we focus on how they approach their individual angel investments. But we've actually had quite a few people from our own audience read your reports, listen to your own podcast, and pose us with a question. So I'll just read one off. So I'm a first-time investor looking at an EIS fund. I want to know, what are the things that you would look for when considering a fund? So there's the prompt for today. If you didn't mind starting off with just a little bit of your background so people know where you come from and what you do and why you're the right person to talk about this, that would be great.
Okay, so my background is originally started off as an actuary in an insurance company, then went back to academia to get a PhD, spent a decade as a fund manager, working primarily in quoted equities, but did do one or two more esoteric things. And then I moved into what we call the sell side, which is basically producing investment research for investors. And I've been doing that for the better part of a decade now. And perhaps most relevant to the listeners here, about 8 years ago, we got involved in EIS funds, VCTs, business relief products, writing reviews on those, and occasionally the odd company as well. What I'm aiming to do is try and help investors make better investment decisions.
How many funds do you think you've covered in your time? Ballpark figure.
I've probably looked at more than 3 figures worth of funds, but in terms of proper analysis, I'm probably getting on for 3 figures.
You've got some good experience then with the venture market, which is what we're going to talk about today, because as you know, tax season is upon us. People are thinking, all right, I've done my ISA and I've done a little bit into my SIP. I've got a little bit of capital that I want to do something more adventurous with. And we're going to dig down into that and look at the different aspects of a fund and what makes them tick and some of the differences. So diving right into it then, what is it that you start out with? So fresh fund comes to you. What is the first thing that you want to look at before going into anything else?
So when I write a review, there's 2 things I'm sort of focused on. One is the fund kosher? Do they have the proper structures in place? Secondly, what differentiates it from other funds in the market? Because it would be very easy for some people to come up and say, oh, I'm a technology fund, and there's 20 or 30 technology funds out there. If a fund can't differentiate from everybody else, then really, where is its place in the market?
What's the first thing that you're going to look at?
Usually I would look at the investment process, I think. That's the first real filter in terms of what are they looking at? Say you're looking at C-stage funds. Can they articulate the sort of companies they're looking for? Can they articulate what's the characteristics of those companies? Can they articulate what would make a good investment, what would make a bad investment for them? Bear in mind, of course, there's more than one way to do it. If someone can only turn around and say, yeah, I'll know it when I see it, that doesn't inspire confidence. Even generalists will typically find there will be biases in their portfolios. So we're trying to understand that process in its entirety.
Talk me through the basic due diligence that you're doing.
It's really kind of the factual stuff about managers and their support. Does the manager exist in a sense? What's the company? What's the company structure? Who owns it? Are they regulated by the FCA? If so, what permissions do they have? Some funds have an advisor and a manager. What's the relationship there? Is there a custodian in place? Who's the custodian? Again, are the appropriate permissions in place? When do funds close? How fast they invest? Anyone who goes beyond 12 months, not really doing good enough. We do uncover some funny things about ownership that maybe weren't transparent in the first place. We did see some issues in the past, particularly in the capital preservation time, when people were effectively setting up companies and there were conflicts of interest all over the place. We see much less of those now, I'm pleased to say, which makes me a lot more relaxed and comfortable about looking at these people.
We should touch upon the active versus passive management. Obviously, in venture, it's more traditionally an active market with a few passive managers, where in public markets, you've got much more passive coming through. Active versus passive, let's start with that in the venture space.
So the case I would make is that active is a much more viable approach in the venture space than it is in the quote markets. There are plenty of research for quoted markets saying persistence of performance for mutual fund managers isn't there. You can't find it. There are a small number that do steadily outperform, but they are no more than you would expect statistically from the pool. And that's one of the reasons why passive funds have risen in the quoted markets, because why would I pay 1 or 2% a year for active management? And I've heard the same thing say about the hedge fund space, is that if you go back 20 years, there were 100 managers creating alpha. Now there's 2,000 hedge funds, and there's still only 100 hedge funds creating alpha. The venture market is different. The academic evidence suggests that there are some persistent performance. Anyone who works in this market for any length of time realizes that it's very hard for it to be efficient. There is no quotation of prices. There is no standard information disclosures. If somebody's got privileged deal flow, then a deal could happen and I will never see it. I'll never even get a chance to participate. So yeah, so active management is definitely a viable approach. Whether it's the only approach, that's a different question. You've got a different approach. I think it's a good approach as well. Both, I think, are valid in this market.
Okay. I'll accept that. Do you have any data on performance of sector-specific funds versus generalist funds? Is it comparable, or is there a bigger range of returns in a specialist versus a generalist fund? How does that look?
The challenge to the EIS space and VCTs as well is that performance data generally is shallow. If you're saying you want 30 or 40 as the minimum portfolio, you're looking for that sort of number of exits to give reliable performance data for every company. Now, the reality is I know one EIS fund that's currently open that has more than 30 exits, including failures.
Wow.
I know a handful in 20s, and then once you get to teens, there's a few more. Even VCTs, they've changed their investment strategies. So people were doing MBOs, they were doing later stage capital. The 7-year rule came in, they're investing in earlier stage companies now. They can't do replacement capital. So even a lot of VCTs are now investing in companies that are different from what they were investing a decade ago.
We've talked a bit about the investment process. Let's talk about sourcing, the different ways that these managers are sourcing deals.
Yeah, sourcing is probably the next most important thing. Managers need to be able to source good deal flow day in, day out, or week in, week out. So typically what you see is 2 or 3 different arrangements. So most managers get strong deal flow from their network. They've been working this area for a while. They know a lot of people. People will send them deal flow. And generally that's quite good quality deal flow. If someone's ringing you up, they'll know who you are. They know what you're interested in. Within that, there's some more structured sort of things in terms of relationships with universities for spinouts, accelerators, incubators. Most fund managers now are trying to build relationships with accelerators where they get in before the demo day. So they're trying to get ahead of everybody else. Competition is tricky. There's a lot of co-investing, and sometimes I think people in this space are kind of frenemies, if you like. The third deal flow is sort of cold deal flow, and generally that's lower quality. That's not to say there's nothing relevant ever shows up there. Most good companies will find somebody to introduce them.
We're seeing a lot of referrals now from other companies as well. So companies we've backed before who seem to network with other good founders who attract angels. That goes along with reputation of the manager as well. You get a manager that has a good reputation of being useful and making introductions, and then all the entrepreneurs want to get introduced to them, so they'll ask their friends or someone they know. And
yeah, if you're going to look at this, we're going to ask questions. It's not so much about the top of the funnel, because most managers will say, I can see 1,000 deals a year. What you want to see is how many are getting beyond that first 2 or 3 stages of filters. If someone's only getting 10 deals coming through and you're getting 10 investments, they're not actually choosing from a very big pool. What you want to get people who sort of saying, okay, I'm seeing 30 or 40 or 50 companies that look like they might be of interest, and they're getting through the first couple of stages, and then we're rejecting, because then you know you're actually getting proper quality rather than just sort of saying, we've only found 10 companies that fit even our broadest criteria. And this is the problems that new managers can have, where if you've got someone who's coming in, there's only 1 or 2 people. Can that network provide adequate deal flow? If a fund survives 5 years, they'll probably build it.
You look for entrepreneurs that have product market fit, but here you're looking at fund manager fit. Is this the right manager for that fund?
Yeah, and some of that's also about depth of networks. So some of these things overlap in terms of, because that's for sourcing and support. If a manager's embedded in a network, they can then provide support because they can make the appropriate introduction, which is kind of what most generalist managers do. They're saying, well, I know these 5 marketing specialists who are going to come in, and this one does social media, and this one does Google Ads and whatever. So these are people I can introduce you to who will help you.
So we talked about the investment process. We talked about the sourcing capability. What's after that?
Well, what happens investments-wise in that once a fund is invested, what are they doing with the company?
So is this how active they're involved?
Yeah.
Are they taking a board seat? Are they?
Yeah. So it's simply understanding their philosophy and what they're doing for companies. Most managers, or almost every manager, will say, yeah, we support companies after investment. But that can vary quite widely. They should be able to say what they typically support them on. So it says, oh, yeah, we go along and we give strategic advice at board meetings. Well, yeah, la-di-da, thank you very much. But if they say, well, actually, what we find is that companies typically need to develop their finance function, we find CFOs. Something that's quite specific tells you how actively they are involved. So you're looking for specific examples.
On that front, looking at our own fund, we have a very different approach. Obviously, we do lots of investments. We're not trying to be actively involved in the companies, although we do say we will make introductions at the next stage of funding. How important do you think that element is? Not just looking at it in the context of because I'm saying we do it, but how often are the funds helpful at the next stage?
I suspect it's a slightly mixed bag, but on balance, I would say most funds are probably quite good at that. At the end of the day, most funds are connected with other funds out there. Most of them have co-invested with somebody at some point. So they are capable of giving warm introductions, and particularly specialist funds. They will say, well, actually, I invest in this area, and I know that there's these 5 funds are really strong in doing Series A, if I'm the seed investor or whatever. So these are really good to introduce to. And obviously, this is very much in the fund manager's interest because, as most people listening will know, companies rarely need one funding round and that's it. If they're getting a seed investment, there's generally going to be a Series A, possibly a B or a C as well. So most established managers will have seen who's investing in the next rounds of their companies. Some managers obviously are creating later stage funds and being multi-stage themselves. They might be able to effectively do the pro rata for the Series A or B, but they can't do the whole Series B round.
Very true. Progressing. So after you've looked at what happens after the investment, what are you looking for and what are you taking into consideration?
The next most important thing will actually be the fund management team and the manager itself. One of the concerns that I sometimes see, and particularly this is smaller managers, is do they have enough people? You've got a portfolio of 30, 40 companies, and there's just 2 of you doing that. That's a lot of company support and find investments. Getting appropriate size of team is appropriate. Some cases you have to understand they'll have an advisory board or you've got angels who are doing a lot of that support work. It's not just a case of the team itself. You've got to look at the environment in which they operate. I find very few managers do not have the appropriate experience. 1 or 2 times I've seen people who have been entrepreneurs, they've turned to fund managers, they've done a few angel investments, and maybe it's a little bit earlier than you might like, but they still have that entrepreneurial experience. It concerns maybe more about processes and managing wider relationship with investors.
Going beyond the team, what have we got next on the things you're looking for?
So I suppose next importance is fees. Nobody's favorite topic apart from fund managers because they always like to be paid them. And fees are kind of what I think to some extent is a negative filter. So no one's ever going to buy a fund because of the fees, but people are not going to buy a fund because of the fees. It's an area that's actually trickier for investors than it looks because there's a little bit of lack of transparency. Do fees get charged direct to investors? Do they get charged to the companies? Fees getting charged to companies are perceived as somehow not being paid by the investor a little bit, which is clearly not true. There is an efficiency from a tax relief perspective, but that's second order. All other things being equal, you'd rather have your fees lower than higher. But it still should be a second order effect relative to the return you're getting in venture capital investments.
I agree with you on that. And you should obviously read through the full of the IM and understand all of the fees because typically the headline fees are there's a setup fee, there's an annual management fee, and there's a carry. But then underneath it, you've got escrow account fees, processing fees, EIS certificate fees, and all these other little things. So read everything. But one thing you mentioned about was charging the company versus charging the investors or doing kind of a blend of both. I don't think people fully realize the impact of charging the company and how that comes across in potential performance or returns. So if we could just touch upon that for a second.
So in essence, what happens, companies get charged 2 fees typically. You'll get an arrangement fee, which is some sort of upfront fee, and you'll get what's sometimes called a monitoring fee, director's fee, something like that. There are managers out there who say, we do not charge companies anything. And what they claim is that that gives them access to better deal flow, because companies, if they have a choice, they will pick the cheaper deal for them. And there's certainly cases we know where two investors have co-invested, one's had a fee, one hasn't. The one with the fee has paid a higher price. So investors are effectively going to pay for that because they're going to get reduced performance relative to the other fund. On the other hand, so things like directors' fees, if a fund manager wasn't a director on a board, would that company have to go and get a director anyway? And would they have to pay that director a fee? They might be paying fees. They might be getting services for those fees. And I know there's one manager out there who has what looks like quite high charges as a company, but they say we satisfy that in terms of, because we provide such great support, that's worth it to them. To the extent they're attracting investments and people are taking money from them, maybe that's true. It's very difficult as an outside observer to validate that in detail. You can get references sometimes. Obviously, the references you're going to get are going to be the nicest ones. And it's very difficult to know across the board about what someone is doing in the portfolio as a whole.
You did a report that I want to highlight because you talked about broader portfolio construction and what percentage of someone's bigger portfolio might want to go into venture capital. And I know you can't give advice, but you did have a finding from that report, which people can find on the Hardman website. What was that range and what was the impact it had on a portfolio?
So I thought about things in terms of equity bond sort of splits, because the usual base that people have talked about for decades is this sort of 60% equity, 40% bond exposure. And with bond rates being lower, probably people are more like 70-30 or 80-20. This suggested that you should have roughly a low teens percentage in venture capital. If you're going up to 80-20, it's more like high teens. And that would add roughly 0.5% to 1% a year to your expected return without changing the risk profile of the portfolio. And that's the last thing I can't emphasize enough. It's venture capital is a diversifying asset. It can improve your expected return without changing the risk. You've got to rebalance your other assets, but that makes it a really valuable part of our portfolio.
On that, and delving into the bonds versus equities, let's call it 15% you're going to put into venture capital. Should that 15% come evenly from bonds or equities, or should it come more from maybe equities because there's maybe more correlation between the equities and the venture, or is it not at all like that? Keep it an even split?
No, actually, it's even more than you might think. So if you want to keep the risk profile of your portfolio constant, you need to take everything out of equities and then some more out of equities and move it into bonds. Even though it's diversifying, you're still adding a risky asset. So if you're going to keep the overall risk, you're taking some money out of equities. So if you took pound for pound from venture capital into venture capital for equities, you haven't actually reduced the risk. You added a risky asset and reduced the middle risk asset. So what you want to do is take some out of the middle risk asset and move into the lowest risk asset.
Okay. So if you were 60-40 and you're putting 15 into venture capital, what does the remaining split look like?
You'd probably want to move about 20 or 25% out of that equity exposure.
Okay. So if you were 60-40, you're taking 25 out of equity, 15's going into the VC side of it. You're ending on 50% in bonds, 15% in venture capital. And if I do the maths right, 35% in traditional equities. And that's closely risk adjusted to the profile that you had 60-40.
Yeah.
Coming to the next point. So talk me through how you view the horizon for a fund. How EIS funds are typically modeled on when they expect money to be paid back. Most funds seem to in the industry say, oh, there's a 7-year horizon and at year 7, you're going to get X amount back. But as we know, things tend to take longer. And oftentimes, even at year 7, if there has been good cash returns, there's quite a bit in paper value.
So this is one area that I think the EIS industry is shooting itself in the foot. I think later stage investors sometimes talk about 4, 5, 6 years. Earlier stage investors, they're talking 5 to 7, maybe longer. There's a really good blog article by Fred Wilson at USV in New York. And he said he doesn't know why it takes 10 years to build a company. And that's an on average. So there's some that will be shorter. There are some that will be longer. They may be right. If you look at the number of companies, maybe 5 years is going to be the right average for the length of exit. But what that means is that in years 2, 3, 4, you've got all the failures and all the successful exits are coming years 7, 8, 9. So on average, yes, the companies have exited in 5 or 6 years by an average time by company. If you money weight that, the real average is going to be significantly longer, I think.
So going back to, I'm a first-time investor in the EIS fund. I read this thing about year 7, disregard it, think about it as, kind of a 10-year or...
Yeah, I would say investing in the EIS fund is a decade-long investment.
So we've covered a lot of ground and a lot of things to go through. What's keeping you motivated for this? Because you've even added a podcast. You're doing all these exciting things with the company. It's not just doing the reports. What's driving you?
It comes back to this idea of educating investors. Even in my hobbies, I seem to enjoy helping people learn stuff. I've got another couple of white papers in my head with stuff that is radically innovative for people that people in this sector haven't seen before. That will help people make better investment decisions.
Any clues as to one of them or when it might be ready?
I'm hoping that at least one of those will come out this year.
Okay. Yeah, we end every show with a bit of a quick fire round, if you will. Number one, let's fast forward 20 years. You decide to retire and you look back on your time. In a nutshell, what do you want that legacy to be?
If I had one legacy that I would like to say, it's where this sector becomes investment-led, not tax-led. There is an investment case to be made and it's lost behind the tax reliefs.
I like that. What's the best book that you've read recently from any genre? It doesn't have to be finance.
Can I give two?
Sure.
One is The Power Law by Sebastian Mallaby.
Okay.
Which is a history of the venture capital movement in Silicon Valley. I read about 2 or 3 months ago. I've been talking about nothing else. If anyone listens to my podcast, it probably crops up almost every episode at the moment. The other one I would recommend, which is not fine. Well, it's kind of finance related, is Bill Browder's book. I think it's Browder, Red Notice. And it just tells you a lot about the state of Russia. And it's a thriller that happened in real life with very tragic consequences in it.
No, it's a good one. It came up, actually, someone else recommended that maybe a year ago, so it must be good. I usually ask, what's your favorite tech trend to the angels, but I'm wondering if maybe I can flip that to what's the most interesting thing a fund's doing that you've seen lately?
I think the one thing that I'm seeing people struggling with and getting to grips with a little bit is applying technology. So someone a couple of years ago on my podcast described the EIS fund management industry as a cottage industry. For a bunch of people who were technology investors, they were very bad at using it themselves. And I think that's getting better. We've seen people initiate systems. We've seen client reporting, lots of logins. Some people have done very smart things with Salesforce, whatever, and built CRMs for investing. We're actually seeing genuine application of technology, rather belatedly in my mind. But
no, you're right. I didn't think about it like that, but a lot of things are still Excel sheets or outsourced custodian, outsource this, outsource that. But do you think it'll result in lower fees for the industry, or do you just think the fund managers will have higher margins because the technology will make it more efficient?
I'm not sure it's going to make a lot of difference to margins. A lot of managers have a scale issue already. Having the staff to support a company costs money. And if you're capped at a £5 million investment, or in a lot of cases, a £500,000 investment, if you're getting 1% on a £500,000 investment, that's £5,000 a year. And you're saying, well, that funds 5% of a decent person to support you. Performance fees are the only place where a lot of these fund managers can really make money. Although some of them do try and get them in other places too.
Yeah, all those hidden fees, transaction fees and custodian fees and such that don't always come to the surface when you're looking at a fund, but one for another day. All right, well, if you had to give yourself just one piece of advice before making your first EIS fund investment, what would that advice be?
Don't think of it as a one-off. You need to be thinking over, this is my investment philosophy for over a period of time, not a one-off where I am today.
Okay. And from a personal advice perspective, if you could tell yourself one bit of advice when you were just starting out with your first job, what would it be?
Be patient and keep going. I think, I've had a career with, frankly, some downs as well as ups, and it's been sort of tough getting through those. But so far, I have. You just keep going and you can endure and come through on the other side.
Perfect. For those that want to follow you and your work, what's the best way they can find it and get in touch with you or connect?
You can find all my work in this space on the Hardman Co website. We call it Tax Enhanced Services. So all the stuff's there. You can find me on LinkedIn, or any report has my email address at the bottom of it. So you can find my email address there.
Well, Brian, Thank you very, very much for sharing your insights. I know the listeners will appreciate it. I hope this is not the last time we speak on the podcast. We can maybe keep it as an annual thing and talk about the different trends that you're seeing in funds. But for now, thank you ever so much and have a lovely rest of your day.
My pleasure. Thank you very much for inviting me on.
Well, I hope you enjoyed that episode of Angel Insights. And if you'd like to stay in the loop, please do register at www.syndicateroom.com or follow me at Tom Britton or at SyndicateRoom on Twitter. And be sure to tune in a few weeks' time for our next episode. It's going to be a good one. Bye.